All right, good morning, everybody. Welcome to our webinar, Deceased Estate Taxes. Before I introduce myself and our company and our speaker, Jannie Rossouw, just a few house rules or webinar rules, whatever you want to call it. We have muted everyone. Please keep yourself muted. Turn your cameras off. That apparently assists with the bandwidth. Please ask your questions in the chat box. Questions will be answered after presentation. I will read the questions and ask Jannie to answer that. This presentation is being recorded. The link for the recording will be sent to you via email. The moment it is being edited, then we will send it to you. And if you have any general questions about the webinar, please email charlene@janljordaan.co.za. All right, people, I'm Jan Jordaan. I'm the director at Jan L Jordaan Inc. Attorneys. There's my telephone number, my email address, as well as our website. Now, if you want to be added to the list of people that we send out emails for our next webinars, then you can go to our website, scroll right down to the bottom. You will see that it says clients. Underneath clients, it says subscribe, and fill in the list, and we will then, the system will automatically inform you about our next webinar. By the way, our next webinar is a two-session series about wills. The first one is testamentary trust. Our speaker there is Via van der Spey. And our second seminar, a webinar on the 30th of August. The first one is the 23rd. The second one is the 30th. Our speaker there is Professor Linda Schoeman, and she's going to discuss with us a few things like massing, fideicomissum, usufruct, and a few issues that we have with wills, etc. So we're looking forward to that two-part series. Right, more about our firm. We specialize in the administration of deceased estates. We have a joint venture or a fee referral. You're welcome to contact us to find out more about it, where we will do the estate and we share the fee. We also have an agreement in terms of wills, where we will attend to the drafting of your will at no charge. We've got a questionnaire, should you want to make use of it, with your logo on. You can send it to your client, send it to us. We draft the will and we send it back to you. Please contact me or info@Jan L Jordaan if you want to know more about it. We also specialize in the deceased estates property transfers. We've got a whole department doing that, quite busy. We also conveyancers. We do transfers of properties, registration of bonds, cancellation of bonds. We're also on the panel of ABSA, FNB, Nedbank, and Standard Bank. We do antenuptial contracts. And then we do trust, the registration, amendments, etc. with trust. And then also we act as independent trustees. I'm sure most of you are aware of the FICA Act and the Trust Property Control Act and the amendments, the 10 million rand or 5-year imprisonment if you're not doing the trust or the trustees don't do their job properly. But that's enough from our side. Our speaker today is Mr. Jannie Rossouw. I've known Jannie for many, many years. Something that I forgot, you'll see there on the right-hand side of this slide, we are celebrating our 30th year of practicing for my own account. As you can see, Jannie Rossouw, he's been practicing for his own account since January 1988 for 34 years. I think I've known Jannie for about 30 years. Jannie is a chartered accountant. You can see all his qualifications. Currently, his occupation is that he's the director at Optima Auditors Incorporated, Optima Tax and Accounting Pty Limited, as well as Optima Executors Pty Limited. Field of specialization is deceased estates and their taxes, state duty valuations, and on the right-hand side, you'll see Jannie's contact details. If you want to make a note of that quickly, you can take his number and email down. All right, Jannie, thank you so much for joining us today. We're looking forward to the presentation. I see we've got 211 people attending this webinar. There's obviously a huge interest in it. Thank you for your efforts. And then over to you, Jannie.
Good morning, everyone, and welcome. And I hope that you're going to spend your time well with me today. I'm not a good speaker, but we'll concentrate on the slides then to make sure you get everything that you need today. All right, so I'm asking you there on the first slide, is your pencil sharp? Now, as we go through the slides, you'll pick up what I mean by that. There are a couple of very interesting things in taxes of deceased people, but we'll deal with that then as we go along. Next slide, please, Jan. Right, so today, well, there are many laws involved in deceased estates, but for this presentation and for taxes, we're going to look at three. And it's very important to look at these three taxes separately, these three acts separately, because they are to be dealt with separately when you do deceased estates. And you need to see these things or these acts in parallel. Later, I referred to the parallel system. And that's what it is. If you don't do your taxes of your estate parallel with your L&D, you're going to run into trouble, or you're going to run way out of time to get the tax sorted. So let's just first look at the laws. The first law or act is the Administration of Estates Act number 66 of 1965. Most importantly of that act would be Regulation 5. Regulation 5 will tell you exactly how you should prepare your L&D. You do not prepare an L&D for tax purposes or for estate duty purposes. In the past, your L&D actually was a copy of the document for your estate duty. That's not what it should be. It has been like that, but you have to look at Regulation 5. If you never read Regulation 5, that's your first homework for tonight. Print a copy of Regulation 5, read it, and make sure that you understand what goes into your L&D. Most importantly, what value goes into your L&D. The value in your L&D for a specific asset or property could be different from the value for income tax purposes. And there could be a further different value for estate duty act purposes. And that's what we're going to discuss, to see the parallel working of these things and how they link together. All right, so there we are, Regulation 5, no problem. Now we move on to the Income Tax Act. Now, the Income Tax Act will make good reading. I think the book, if you buy a book on that, will be a couple of thousand pages. But what we're interested in is the income tax itself. And then Schedule 8 of the Income Tax Act deals with capital gains tax. Now, just bear with, I said Schedule 8 of the Income Tax Act deals with capital gains tax. I think you caught that. So capital gains tax is part of income tax. It's not a separate tax. It's a separate or a different way of calculating, like farmers, that's Schedule 1. Farming tax is calculated in terms of Section 1, but it's income tax. Pay as you earn and tax on staff, I think that's Schedule 2. So and Schedule 4. So there we go. So it's an income tax, but the calculation method is prescribed in Schedule 8. Very important. So once you have calculated your capital gains tax, you add whatever gain you have to your income and you tax it as income. Right, so there are rules regarding that. Estate Duty Act is obviously a complete different act with its own set of rules, and those values for estate duty may be completely different from the values in the Income Tax Act and that for L&D. Good example, farming property. All of us know that if there's a bona fide farming activity going on a piece of farmland, you get the 30% discount for estate duty. You don't get that 30% estate discount for income tax or capital gains tax or for your L&D. Let's say, for argument's sake, this person said in his estate, in his last will, that his sons are to inherit the property in equal shares. So the one property is a farm property, or the estate rather, in equal shares. His whole estate has to be divided in equal shares to the sons. The one son will get a farm, and the other one will get a property, an urban property in a town. You cannot deduct the 30% for that purposes, because then the value is too low. The guy with the farming property is going to get too little or too much. So you see what I'm trying to get at is that value that's in the R&D should be the correct value, the value that's prescribed in the Regulation 5, meaning fair market value. That goes into your R&D. The adjustments from the R&D to income tax for capital gains tax and for estate duty, that you do later. So very important, the nucleus of your taxes is your R&D. Right, let's move on. The next slide, please, Jan. So now we're going to talk about the taxes. Now, on the 1st of March 2016, Section 25 was amended. There's always been a Section 25, but it's been amended, and there was introduced the new Section 9HA. Let's just first deal with Section 25. Section 25 says that at the date of death, a person's tax year ends. But one day after that date of death, a new taxpayer gets in existence. That's the deceased estate. So now suddenly in the year of death, you're going to have two taxpayers. You're going to have the deceased until the date of death. And after that day, until the end of that financial year or that tax year, which is February, because it's an individual, you'll have the deceased estate. The deceased estate is an individual. So deceased estate can be married in community of property. If the deceased was married in community property at date of death, that community carries on, although the marriage dissolved. The deceased estate is a single person under the age of 65 and married in community property if that had been the case before death. So only half of the interest and the rental income gets taxed there. So you need to keep track of that. So that's very important to understand that Section 25 now specifically state that the deceased estate has to be registered as a separate taxpayer. We'll get to that just now. That has to be done. Now, Section 9HA is all about the capital gains tax. Now, Section 9HA says that the capital gain that is created, the deemed capital gain created at the date of death of the person that passed, it says that at that date, he has deemed or she has deemed to have disposed of all of her assets, and there will be a capital gain. Although you never sell that property to anyone out of the estate, there's a capital gain. Even if you award that to someone, there's a capital gain. Now, that capital gain needs to be calculated and taxed as income tax in the hands of the deceased. So now that particular asset rolls over to the estate at the value which it had been disposed of, so-called disposed market value. And that will be the base cost for the deceased estate. So now if you sell that asset out of the estate, then there will be a second capital gains tax calculation. 9, capital H, capital A, very important. So keep this in mind. If you look at your L&D, once again, very important, L&D, every item that has been awarded, there will be one capital gains tax calculation. Every item, obviously the item must be subject to capital gains tax. We'll get to that just now, which items or assets are subject. So if this asset is subject to capital gains and it is awarded, one capital gains tax calculation. If it had been sold or collected, like a unit trust, collected by the executor, that will be after death. There will be a second capital gains tax calculation, the post-death capital gains tax calculation. So that's very simple. So if you look at, once again, go back to your base, go back to your L&D, it'll say awarded or sold, and you will immediately realize, okay, for every item sold, we're going to have 2 capital gains tax calculations. And that's important to note that. Thank you, Jan. We can move on. Right, we dealt with the deceased until the date of death. We said the estate will be a taxpayer. So that the state tax year starts at the day after death. It ends when? It does end. It ends on the last day when the L&D has lain for inspection without any objections, that 21st day. Then it ends. So you as the executor need to take care of all those taxes until that date. So why is that the case? Because in terms of law, the heirs are entitled to collect their asset or their money or whatever it is one day after that L&D has lain for inspection without objection. Then they're entitled to collect, and you have to make over to them their inheritance. So then they become entitled to it, and then the tax becomes their problem. So now the problem with this is the following. In many times, you have an heir sitting overseas, and you can't send that asset or transfer the money in time. So we'll get to that just now. Now you're looking after the heirs' tax affairs for a little bit as well. And you have to issue the IT3 A, B, and C's for that person if he or she had earned income, interest or rental income, or whatever the case may be, until the time they take care of their own property. So what I'm trying to say is you need to keep the heirs also in mind when you do the estate and the taxes. So let's go back. The deceased, very simple, up to date of death. The estate, your baby, until it's laid for inspection. The heirs, your baby, until they take over the asset themselves. I think I've made that point. So you deal with 3 different taxpayers. Thank you, Jan. Let's move on. So first of all, we have the deceased. Now, look, if there's a will, you want to be in it, I think. But you don't want to be the deceased. I think you preferably want to be the executor or somebody inheriting, a legatee or whatever the case may be. But okay, in this particular case, you are being appointed as the executor or the agent, so you are now representing that deceased. In this particular case, it's me. There's not enough room on this little slide to put all of your logos and stuff on here, so I couldn't do that. So my apologies. But for purposes of this, I will now represent this deceased. Now, representing the deceased, you have to be appointed, first of all. You know that you have to be appointed in terms of the Master of the High Court Administration of Deceased Estate Act, and you have to get your letter of executorship. Without that letter of executorship, nothing can happen. Or if you're the agent, you have to get your agency agreement or your agent power of attorney, and then only you can start working on this estate. So once you have that, you can start working on the estate. Now, before you get there, the family will come there, meet you, they'll give you all the data, you will get all the details of the inventory, and then you will be able, you get the will, and then you will be able to register the estate with the master. Now, at that point already, you will be able to determine what is going to happen in this estate. Are we going to spend hours and hours and hours on taxes, or are we not going to do that? And it's very simple. If you look at this will, and this will says, I, the undersigned, blah, 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 bequeaths to the surviving spouse my entire estate. There shall be no capital gains tax. There shall be no estate duty. You don't have to worry about those taxes or estate duty. Why? Because for capital gains tax purposes, it's a rollover. Everything that goes to the surviving spouse would not attract capital gains tax at date of death. It's a rollover. If it's been bequeathed to the surviving spouse, you all know Section 4Q, it's not subject, it's a deduction. So therefore, you don't have to bother about the taxes. You don't have to bother about the values you put in. You can actually put in R1. Your fee will be 35 cents. You're going to battle to get that fee paid, the 35 cents in cash, but no, you can't really do that. You have to put in the market values, fair market value in your L&D, but you don't have to bother about the values for tax purposes. Now, if you look at that will, and you'll note that this, the second point where you can pick up what's going to happen in taxes is the inventory. If that inventory has one home, and that's the primary residence of this person lived in that property, and he has one motor car and one investment, you know the taxes is going to be very simple to do. But if this person had been a director of Standard Bank, and he has assets and investments all over the world, you know you're in for a good ride. You're in for a good one. You have to have your pencil sharp. That's why I said in the beginning. So right at the outset, you will be able to realize, are you going to have to get in an expert for this tax or don't you? The will and the inventory will tell you that. So if this person did not bequeath everything to the surviving spouse, if he, for instance, bequeathed something to a minor child, problems. If not problems, you have to then you know, okay, there's a bit of work to do here. If he bequeaths some stuff to a trust or to his children direct, then you know, and the value of this estate is more than, let's say, 7 million for purposes now, 3.5 million, then you know there will be tax. So what I'm trying to say to you in this particular slide is, at the time when this family comes to your office, you will know. From there, even before this estate has been registered with the master, and you get your letter of executorship, your appointment, you will know there will be tax problems. Not problems, there will be a challenge. Let's use that word. You're going to work on these taxes, so you have to get somebody in to deal with them. Right, so that what I'm trying to say is, at that point, you already know what's ahead of you. Next slide, please, Jan. So now you have in your possession your appointment letter. The very first thing you do is you register the deceased estate as a taxpayer. Now, once again, you don't have to register this deceased estate as a taxpayer if you can see that the income that the estate is going to earn after this person's death is going to be minimal. Right, how do you do that? So you have to know the tax law to understand when will this deceased estate pay taxes. This deceased estate is an unmarried person. Interest earned up to the point of 23,800 is tax-free. So if this deceased estate, the deceased account you're going to open, is so small that there won't even be 23,800 interest in a year, then there will be no taxable interest. Then capital gains is the next step. If there's no capital gains to be paid in the estate, so let's say everything is awarded, nothing is sold. So if everything is awarded, there will be no capital gains in this estate, in the deceased estate. So you know the capital gains, there's a deduction of 40,000. You will not reach the 40,000, so you don't need to register the estate if there will be no taxes. But in order to do that, you have to know the taxes and you have to know what this estate consists of. Now, if this person has a bank account or investments of a couple of million, 5 or 6 million or even 2 million, then you know for as long as that assets are going to lie there, they're going to earn interest or capital gains, and the estate is going to pay taxes on those, then you can just as well start registering that deceased estate. So the first thing I normally do is I get access to this person's e-file profile. I actually like to have it transferred to my own profile. Why am I doing that? I'll explain just now. Then the next thing is you code the taxpayer as deceased and a deceased estate with SARS. At the same time, you have to appoint the executor as a tax representative. Good luck with that. It's very interesting to do that. You have to stand there. If you're the agent, you have to get the executor standing there with a nice little ID and a nice little selfie, smiling, send that to SARS. I don't do that personally. But yes, you have to register the tax representative. Now take note, that tax representative is appointed in terms of tax law, and that tax representative takes all the responsibility for all these taxes. Now, this could be an elderly lady in the age of 80 years plus, and you're going to be her agent. Remember the principal agent principle, where you can be held liable as the agent of that principal. So if there's trouble, that poor lady of 80 years is going to land in trouble, but her attorney will probably get to you and tell you, we're not going to work like this. You made a mistake. You're going to pay these taxes. What I'm trying to get at here is that tax representative is personally liable for the taxes that is not being paid or are not being paid. Very important. That's why SARS will not code a deceased estate without a tax representative being appointed. Right. So once that's done, you'll get the post-death tax registration number, and that's the one for the estate. And then what you do is, let's go back to point 1 at the top. You gain access or control of the deceased e-filing profile. Now you need to research this person's tax profile. If you're an accountant and that person had been your client for 10, 20 years, then you've got everything at hand. This is not going to be research. You don't have to be a private investigator to find out what's going on in his or her affairs. But if this person just walked into your office, the family, you know them from nowhere, then you'll have to be a bit of research. You have to be a little bit of a private investigator to figure out what's going on in this person's private life. The family will give you lots of stuff. Now, many families work in such a way that the husband shares nothing, argument's sake, with the wife, or vice versa. People come there, the children give you the stuff and tell you, we know nothing. We never had insight on our dad's affairs or my mom's affairs. It's up to you to sort them out. So now you put your nice little cap on and you become a private investigator and you start researching. So when you get that e-filing profile, you open up the last assessments, 3 years. I do 3 years. And I see what's going on. I print off. I'm old school. I still print. I still use trees and paper and things like that. I can't work with 3 or 4 screens like the youngsters. I can't cope with that. So I print off the last couple of assessments, but I also print off the last couple of those 3 years at least returns to see what happened, what has been declared. The assessment doesn't give you all the detail, but the returns do. Now, when you're lucky, you'll note that 1 or 2 of those assessment or those returns were subject to a review or whatever they would call it. Then it's easy. Then there are documents. Then you can print off those documents. Now you have more details. Now those documents, when that specific return was under a review or under, what do they call it? I can't even remember that term. Then you can see the documents that are submitted to SARS, the supporting documents. Then you can see, oh, this person had 99. That's the old investments. Oh, we had a bank account with African Bank. Oh, we had these shares. Oh, we had this and that and the other. Now you start to get the feel for what this tax is all about. So what I do in my practice, I have a little spreadsheet and I put down all those details for 3 years. Oldest year at the back, and I put them down, and then I come to the year of death, and now I look at what I have in the year of death on file and what the family has given me, and then you figure out what is missing. And if there's something extra, you investigate it. I'll show you just now another slide what that looks like. And then you obtain from that e-filing profile, you get the taxpayer's account. Why do you do that? Because you need to see, when last was this person assessed? When last did he pay anything? Is there a balance on his account? So the balance on that account could be a credit or a debit, but that will affect your L&D. And that will affect your assets or your liabilities, and that will affect your estate duty. You cannot finalize the estate duty before you finalize the tax. Because if this person has a tax liability at date of death, let's take into account all these capital gains. I had one case now where the person had capital gains of 10 million. You have to calculate those taxes first, and that becomes a liability of date of death. Now that is a liability that gets deducted for estate duty purposes. You cannot finalize your estate duty without finalizing taxes. So bear in mind, that's just how it is. So that account will tell you what returns are outstanding. In fact, the e-file profile will tell you that as well. But if you look at the account, you'll quickly see what was assessed, when was it assessed, and you can use that account to see what's happening, part of your research. Thank you, Jan. We can move on. So what do you look at? Your second task. Now you've got those returns and assessments and stuff. Now you have to look at the sources of income and what it consists of. First of all, remuneration. Was this person employed by someone? Yes, this person was a director of Standard Bank. So what do you expect? You expect IRP5 certificates. Oh, he was a director at a huge organization. You'd expect huge lump sum payments. You'd expect that. It should be there. If this person had his own little business and he was employed by the business, you still expect the IRP5. If he was a sole practitioner or a sole proprietor, you expect to see financial statements. Not remuneration, but financial statements. So it's of utmost importance to see what the sources of income of this person were. Remuneration. Then you know you expect IRP5s. If there were investments, then you need to know what types and the sources of those. Savings accounts, that's interest. You need an IT3B. Collective investments. There you need an IT3B and C because there are always capital gains taxes there. Those are unit trusts. Listed shares, shareholding. What do you expect there? Oh, dividends. Overseas shares. Oh, foreign dividends. All right. Unlisted shares in private companies and closed corporations, many people has that. Now it's getting interesting. What do you expect there? You don't necessarily expect dividends, but it could be dividends, but you expect a salary. Because this person has got his own business, but it's in a CC, you expect at least a salary. There could be dividends. I have a couple of clients that declare dividends every year because a dividend is a nice, clean way of getting money out of the CC. It's nice for those 5 directors. Those dividends are tax-free. They don't come into their provisional tax calculations and all that nonsense. It costs them a bit more in terms of tax, but it's clean. Keeps their personal tax affairs nice and clean. So a dividend declaration out of a company or a private company or a closed corporation is a nice way of keeping the tax of the individual simple. Retirement income. Okay, this person was retired. Now you need to know what were the types and the sources. Now, and the financial. So now this person earns a retirement income under a code 3910. Now that's the next thing. You have to know these codes. You have to go get that list of codes and make sure you have the right codes at the right places, just as a matter of interest. All the remuneration codes are 36s. 3601, I think, is normal the remuneration. 37, I think those are, those could be, if I remember correctly, those are 38s are normally your fringe benefits. The 37s are allowances. Your 39s, those are normally retirement income. Take note. If you get a lump sum, 3915 is a lump sum. The moment you have a code 3915, that lump sum gets taxed at a different table. All the 36s, 37s, and 38s gets taxed at the normal income tax table. So bear in mind, your 42s are normally your investment incomes. 4201, I think, is normal interest. 4218, I think, is, can't remember even. But your 4250 is a capital gain, and your 4251 is a capital loss. All right, take note of that. So that's, again, if you look at that person's assessment, if you go back one slide, please, Jan. If you look at that assessment, there, second from the bottom, obtain that last assessment. In the assessment, SARS will state every single code that was taxed. That's very, very helpful. Very helpful. That gives you a very good idea of what to expect. And then you look at the codes of the documents that these people send you, because you need to take note that you do it correctly, that you get all the documents you need and all the sources. Thank you, Jan. Let's move to the next slide. All right, so you also have to take cognizance of the tax periods. Right, thank you. So let's look at the tax periods. Very important. Deceased, pre-death. This person's tax year started 1 March 2002, Arguments Act 22, and he or she passed 25 September, 209 days. Why do I put down the days? Because if you look at that assessment, there, second from the bottom, obtain that last assessment. In the assessment, SARS will state every single code that was taxed. That's very, very helpful. Very helpful. That gives you a very good idea of what to expect. And then you look at the codes of the documents that these people send you, because you need to take note that you do it correctly, that you get all the documents you need and all the sources. Thank you, Jan. Let's move to the next slide. All right, so you also have to take cognizance of the tax periods. Right, thank you. So let's look at the tax periods. Very important. Deceased, pre-death. This person's tax year started 1 March 2002, Arguments Act 22, and he or she passed 25 September, 209 days. Why do I put down the days? Because if you look at that assessment, there, second from the bottom, obtain that last assessment. In the assessment, SARS will state every single code that was taxed. That's very, very helpful. Very helpful. That gives you a very good idea of what to expect. And then you look at the codes of the documents that these people send you, because you need to take note that you do it correctly, that you get all the documents you need and all the sources. Thank you, Jan. Let's move to the next slide. All right, so you also have to take cognizance of the tax periods. Right, thank you. So let's look at the tax periods. Very important. Deceased, pre-death. This person's tax year started 1 March 2002, Arguments Act 22, and he or she passed 25 September, 209 days. Why do I put down the days? Because if you look at that assessment, there, second from the bottom, obtain that last assessment. In the assessment, SARS will state every single code that was taxed. That's very, very helpful. Very helpful. That gives you a very good idea of what to expect. And then you look at the codes of the documents that these people send you, because you need to take note that you do it correctly, that you get all the documents you need and all the sources. Thank you, Jan. Let's move to the next slide. All right, so you also have to take cognizance of the tax periods. Right, thank you. So let's look at the tax periods. Very important. Deceased, pre-death. This person's tax year started 1 March 2002, Arguments Act 22, and he or she passed 25 September, 209 days. Why do I put down the days? Because if you look at that assessment, there, second from the bottom, obtain that last assessment. In the assessment, SARS will state every single code because his rebates or her rebates are going to apportion. Only 209 of 365 will be allowed. It gets apportioned. It's at the bottom. I put it there at the bottom. Apportionment of income between pre and post-death year of death. Okay. Now, estate, post-death, day after death, until 20 February of that year, and every single year until when? Until the L&D has lain for inspection, 21st, that last day. Every single year you have to account for that tax. Okay. No apportionment there because it's a full year and there are no rebates. That unmarried person under the age of 65 is only entitled to two things: interest deduction, 23,800, and the 40,000 capital gains tax deduction. Nothing else. No rebates. Nothing else. Right. I think we've got that. Thank you, Jan. We can move on to the next slide. Good. It's just a summary of showing you how the deceased income and the tax periods works. So the first of couple of years before death, you review the history. There it is. But look at the detail there. The income is the remuneration, investment, business income, rental income, capital gains tax, the deductions. You need to see deductions in the date before death, like retirement, medical, annuities, all that stuff you'd like to see there. In the year of death, you'd like to see the same remuneration, investment, business. What has changed? If nothing has changed, you need to see remuneration, investment, business, rental. But now you have to have a deemed capital gain, and you're going to have realized capital gains. Let's say, for instance, this person was involved, he had an investment, unit trust investment. That company will give you, at date of death, will give you a realized IT3C certificate of what they have bought and sold in that year until date of death, and those realized capital gains. But the deemed capital gains is a different exercise. We'll get to that just now. There you take every individual asset and see whether you have to calculate the deemed capital gain. So those two capital gains, the realized capital gain and the deemed capital gain, do not confuse the two. Now, deductions in the year of death. Yes, you need to see the retirement deductions, the medical deductions now. Don't make a mistake with the medical. If the medical deduction in that year could be high. Many people is hospitalized before death, and there are deathbed expenses. So those deathbed expenses, you only pay them out of the estate, but they're deductible for income tax because all of that existed before death. So you may deduct those. So bear in mind, and make sure that those deathbed expenses are claimed from the medical aid and they are accounted for. So don't slip on that one. All right, and then obviously now we have the deceased estate. So we don't want to see remuneration. I've seen some institution, I'm not going to mention the name, issued a 3915, a lump sum for a person in a year after his death. That's impossible. The person didn't live, could not earn that. So if you get that, you write a letter to those people and say, catch a wake up, changes. Make this change. This person was not alive. You've got the wrong years there. What you will note on that document is the one that I got last week. This person passed in 2012. So it says on that IRP 5, it says, or on that document, it says date of issue 2022, tax year 2012. So investigate that document. The tax year is what matters, the tax period. If that says the tax period in this particular case is 2022, you're okay. It's the right one. But if it says the tax period is 2023 and it's a lump sum, it's wrong. So you need to have your pencil sharp because you have to check these things, double check it's correct. Okay, so now you have the deemed capital gains right in the middle, the big fat red letters. If any of those assets were sold as well, they were sold afterwards, then you're also going to have a realized capital gain. Again, big fat letters. No lump sums there, no remuneration. That person could not earn money, earn income whilst they were not alive, and they could not have deductions. So that's simple. So keep that in mind. So some of these mistakes do happen. I think it's purely mistakes, but you need to be aware of that. All right, let's move on to the deceased estate. Thank you, Jan. I've mentioned this. Deceased estate is fairly simple. From the date of death, and then you run through all those tax periods until that L&D has lain for inspection. And now bear in mind, so there's one estate I got, this person passed in 2012. The estate is not even wound up until today. And there were huge investments. So all that broker kept on investing, reinvesting, and made money for this estate like nothing else. So there will be investment, rent income. There will be capital gains every single year because the broker bought and sold shares and carried on relentlessly, which was good. And then all those realized capital gains. But this person also ran this person that passed also ran 3 businesses. A farming business. Okay, I mentioned business. Then if there were rental income, if the person rented property, that rental will come in. But this particular case I'm talking about now, farming income, plantation farming income, and then a lodge, a game lodge income in his personal capacity. And all those business carried on after death from 2012 until today. All of those businesses are to be accounted for, all those incomes. So you have to get those auditors to do those financial statements. You must make sure that that's been done. Why? Because you, the executive, Section 9HA says you must look at this deceased estate and you're personally liable. So you have to get this stuff and get it sorted. The sooner the better. So you appoint those auditors and you get those things done and you get those documents and you get the taxes in. Thank you. And you have to submit returns for every period and pay the tax. And you preferably need to pay those tax out of after death income. But if there's not enough money, good question. We'll discuss that later. Let's move on. Thank you, Jan. Thank you, Jan. The heirs. I've mentioned that. I can just quickly run through this. From the first day the L&D has lain for inspection without objection to the end of that year, that's where you end. You issue the documents. No, that's where the heirs start. Sorry, that's where the heirs start, but you still have to issue those documents if you haven't paid out yet. So you haven't paid it out yet. I can tell you why. Because when that L&D has lain for inspection, you're only going to pay out in a couple of months' time. But in the meantime, the interest is still running on that investment account that you run on your CCMS or whatever account you've got, your investment account for the estate. There's still interest running. So you have to work until the end of February of that year. But if you disperse before end of February until the date that you actually move over or transfer those properties or the money to the individual, then you have to issue those IT3B certificates, IT3C, for the tax year or that shorter period. Once you've done that, your obligation ends. You've distributed all the assets, not your problem anymore. Then you can apply for your filing slip. Next slide, please, Jan. Now we're going to look at the taxes. Time is running. We need to move. I told you there's income tax. I put the capital gains tax separately because it's got a huge calculation that has a huge effect, but it's income tax. Donations tax should only pay in massing, or when a person, there's a redistribution agreement, the person was supposed to get 5 million, now it takes 10 rand, there could be a donation, and then you have estate duty. Those are the taxes. We're not going to deal with donations tax at all today. We're going to deal with income tax, capital gains tax, and estate duty. And let's get going. Thank you, Jan. And now let's look at the parallel process. There we go. I've mentioned. Now we're going to look at the taxes. Time is running. We need to move. I told you there's income tax. I put the capital gains tax separately because it's got a huge calculation that has a huge effect, but it's income tax. Donations tax should only pay in massing, or when a person, there's a redistribution agreement, the person was supposed to get 5 million, now it takes 10 rand, there could be a donation, and then you have estate duty. Those are the taxes. We're not going to deal with donations tax at all today. We're going to deal with income tax, capital gains tax, and estate duty. And let's get going. Thank you. I'm not going to mention it again, but you attend to the L&D and the taxes simultaneously. In many instances, from the taxes you'll pick up, oh, there's been interest earned on an investment, but the family did not know about that. Then from the tax returns, you'll pick up, oh, there's a 5 million investment in this particular company, and then you can put that into the L&D. You never knew that when you did inventory. So that's the parallel interactive process. You have to work interactively. So if you have a big firm where one person does the taxes and another person another person does the liquidation distribution. You'll have to meet at some stage and sit with each other and compare notes. Many attorneys ask me to do the taxes on their behalf. I only do the taxes if I get that liquidation and distribution account, the one that they feel is, it doesn't have to be final, but the best at the time. Then I get access to the e-filing, and then I look at the taxes, and then I start querying the L&D. And in many instances, I would find, because they do not have access to the taxes, so it's not that they're not doing the jobs, it's just then I'll find that there may have been some other assets involved that they did not pick up. Let's move on. Parallel closed process. Okay, here we go. There's your L&D. I have a little spreadsheet where I put in the first tab, I put all the assets down. All the assets. Number them exactly the same numbers as the L&D, which if I do the L&D myself, then the numbers are there. Otherwise, I just copy the L&D from wherever I got it from and put the same numbers down there. Now you take asset by asset by asset, and you look at that asset. Could there be income tax involved in this asset? Yes, this asset is a rental property. I need to see rental income. Okay. Is this asset subject to capital gains? Oh, it's a unit trust, or it's a share in Old Mutual. Yes, there will be capital gains tax. Then, has this asset been awarded? Yes, only awarded. There will be one capital gains tax event. Has it been sold? Okay, I've got 2 capital gains tax events. So now you create tabs. Tab 1, L&D. Tab 2, income tax. Tab 3, capital gains tax. Tab 4, estate due. All those assets get carried over, and then you do the taxes with those ones that are applicable. You can't miss anything then there. So that's why I'm not using, you can use those packages of LexisNexis and very nice packages to do your L&D. But if you want to do your taxes, incorporate the L&D into your taxes spreadsheets. Thank you, Jan. Let's move on. That's a little example. I don't always put any movable property in my little spreadsheet. I just put down the asset. So that's just an example. Let's say, so now you figure out what's the nature of the asset. Take it a step further. For capital gains tax purposes, you need to know, is this a primary residence? Now we're going to deal with the primary residence. If that's a primary residence, let's just go through it. That's F265. This is just simulated. This is not true. 1850 primary residence, it was awarded to the spouse. Now it tells you everything. Will there be income tax? No, because it's a primary residence. We don't expect rent. Will there be CGT? No, it's been awarded to the spouse. Won't be. Will there be estate duty? No, it's awarded to the spouse for Q. Will there be post-death income tax? No, because it's a, and will there post-death sheet? No. That's it. That's how you do this. So now you run, and now you know if there's income. Let's look at F22, virtually sold for. That was rental property. Okay. That's awarded to the residue. Okay, there should be income tax because I'm expecting rental income. Will there be CGT? Yes, there will be CGT because it's been sold. So there will be deemed CGT. Will there be estate? Yes, there will be estate duty. It's not. It's awarded to residue. Let's say the spouse is not part of the residue. Will there post-death income tax? Yes, it's rented. Until the day it's sold, there will be post-death income tax. Will there be post-death CGT? Yes. So in that particular case, 2 CGT events. Let's just look at the one before that. The holiday home, awarded to the trust. Will there be income tax? No, unless it's been rented. Will there be CGT? Yes. It's not the primary residence and it's awarded to the trust. So that's what you do. So you go through each and every asset. That's just an example. I don't think I should dwell further on this, but this is an example. So what I'm trying to tell you is that's what you need to do to figure out what's going on in this estate. Next slide, please, Jan. Capital gains tax. That is actually one of my actual examples. That's how I do it. And then I do it for, this goes into SARS as well. This is an actual case. So that holding 158 base cost. So when we look at the capital gains tax, so in capital gains tax, you need to understand the basic principle of capital gains tax. I'm just going to run through quickly. We have 10 minutes. We have to move. You have a concept called proceeds, and you have a concept called base cost. If you don't know what they mean, if you've never read those definitions, don't try and do this. Don't do this. Get someone to do it for you. There's a nice little guide. I've got it here. There's a nice little guide on SARS's website. If I just get it here for you. It's called Comprehensive Guide to Capital Gains Tax Issue 9. Download that guide, please, this afternoon. It's a nice little bedtime reading. It's about 1,200 pages, so I hope you've got a long night tonight and you can go through that. Download that, put it on your desktop. When you get to capital gains, open it up, press Control F and put the game farming. You'll find everything about game farming, capital gains tax there. All right, enough of that. Download that little comprehensive guide to capital gains tax issue 9. Okay, there's an example. There we have a holding that was a primary residence, but the base cost is a very interesting way of calculating because the holding was more than 2 hectares. Now we have a problem. If you have a farm, the farm is 221 hectares. Let's make it 222 hectares. This guy is entitled to 2 hectares for his primary residence. So that 2 hectares of that 222 hectares has got to be dealt with differently from the other 220 hectares because the values will differ. And there will be a discount of 2 million on that, on the 2 hectares. So you have to study. If you want to do capital gains tax, you've got some study work to do. It could be, it is, not could be. It could be very simple, but it could be very specialized. Okay, so that's what it is. I think I've explained to you. You can see there. Then the vouchers, that's my voucher. That goes to SARS. That 4.5 million. Okay, now look at this. Look at this. Look at this. L&D value 4.5. Value at date of death. That's the value. That's the so-called proceeds. 4.5. It happens to be the same value, but it doesn't have to be the same value. We'll look at that just now. All right. And then how did you calculate the base cost? There are methods to do that. You have TAB 20% of proceeds or the actual. You have to know that. And then there are your vouchers. Then there's an exclusion because this person bequeathed that property to his secretary. But his secretary happened to be his spouse. Why is she his spouse? We'll get to that on the last slide. I think we deal with that. So she gets the spousal rollover because they were together for a certain period of time, blah, blah, blah. So then she gets that exclusion of 1.7. But see, it's not 2 million because this property was in excess of 2 million. So that 2 million gets apportioned to the size of the property. So the capital gain is only 293 in this case. Next slide, please, Jan. Now we get to estate duty. I'm not going to say anything about that. Jan, we can move on. I think everyone saw that. Estate duty. Now, here, we've got 7 minutes. What I see going wrong with estate duty, people don't always understand. Most people do. Most attorneys do. Most accountants do. But many people don't understand the difference between an asset, a creditor, administration cost, and income and expenses. There's a very specific distinguishing between those. You have to distinguish. Assets and creditors, look at the fat letters. They existed at or before death. Their assets existed at the date of death. The creditor is for a service or goods rendered before date of death, not after date of death. If this person lived in a property and you're still paying the security company after death, that would be an expense. But if you pay the last account of that security company until the date of death, that's a creditor. So you need to establish clearly what is the creditor and what is the expense. Any liability up until date of death, paid or unpaid, is a creditor. Now, if you pay that creditor, you cannot deduct that payment off your expenses or add it to your expenses. The expense is for anything incurred, any expense incurred or services delivered or goods delivered, rendered after date of death. Very important. Now, administration costs. I think to explain that, let's look at the next slide. Jan, please. Now, this is a statement that I got from a company called Jan L Jordaan Inc. This is a real case. So, Jan, you're on the spot now. Jan sold this property out of the estate. By purchase price, 1,250. Now, look at that rates and clearance figures until 30 April 2021. Now you have to investigate that. This person passed in 2020. What is that? What is in that little number there? Now, this is a small number. Now, remember, if you don't have estate duty, you don't have to bother about this. But if you have estate duty, you have to look at that. This particular case I'm talking about, that number there for the clearance is 328,000 rand. So what did this municipality do? They just said balance owing at a certain date, 320,000 rand. That's not good enough. What was the balance owing at date of death? That goes into the creditors. The others are for services rendered after date of death. Those are expenses, not claimable against estate duty. So this is a little example with a little number, which is not going to make a big deal of us. Even if you're going to claim that 6.3, I think SARS, Master, everyone will just let it go. It's not having a big effect. But if that number is huge, so in principle, if you just claim that 6.329 as an administration cost, you're wrong. But maybe it's allowed because no one is going to do the trouble to figure it out. But if that thing is like 328,000 rand, you have to look and figure it out. So let's go back to the previous slide, Jan, quickly. There we go. As creditors, assets and credits that existed at or before date of death. Thank you, Jan. Next slide. Okay, that's 6,329, the purple there. You have to get those invoices from City of Tshwane or City of Joburg, or whoever it is, Chief Lutuli, whoever it is, and you have to investigate. Now look at that statements. Electricity is charged 1 month in arrears. This person passed in 28 September. On that account, the electricity will be only for August. The rates will be for October. That rates are not claimable. It's an expense for estate duty, the rates on that day. Then the next statement, you have to get the next statement. Now only you get the expenses, the electricity and water for the month of death, September. So you have to add that to the creditors. You see what I'm trying to get at? Next slide. Thank you, Jan. I think I've discussed that. You get the picture. Estate duty, quickly what it is. Property, Section 3.2 tells you what property is. In this particular case, the property is 35 minutes. Section 3.3, deemed property. Deemed property are usufructs, assets which you are competent to dispose of. You have a trust, but you're the only trustee. You're the only beneficiary. You are competent to dispose of. That gets put in there. Gross value of this estate is 40 million. Allowable deduction, Section 4, 6 million. Net value. So you have to have a gross value, and you have to have a net value. If you do the estate duty calculation, please see to it that you get to the gross value and you get to the net value. Now you get to the Section 4A rebate. We'll discuss that now, Section 4, capital A. And then you get the dutiable amount, 32. First, 30 million, 20%. After that, 25% duty payable, 6.5. Now remember, interest at 6% if that amount was not paid within 12 months after date of death. So you need to, within 12 months, try and get this calculation done. Parallel process. Don't let this thing sit there until the end of this whole process, because you cannot do this before the tax is done. So remember, get those taxes done ASAP so that you can get this document done, this calculation done, and make sure that within 12 months. Otherwise, you have to pay them a deposit. Do that. Do a rough calculation. Pay SARS a deposit. That department of SARS works well. They will refund you whatever you have been overpaid. Right, and then there's a rebate for rapid succession. We're going to discuss that now. Jan, we can move over. Let's just
Jannie, before you carry on, don't worry too much about the time. Let's add another 10 minutes. I think you're on such a roll now. We all enjoy it. That we stop at 10 o'clock or 11 o'clock just because we're out of time. So please proceed.
Okay. All right, yes, because I've still got a couple of things to say, unfortunately. Right, estate duty. What is taxed? Why is it taxed? Which value is taxed? Now that I found many mistakes. And who pays the tax? And there I also found many mistakes. Jan, thank you. Let's move on. Estate duty, just a little example. You can move that slide, Jan. Okay, now this is a nice slide. If you really want the slide, we can email it to you. Property sold. Why is it subject to estate duty? Section 3.2 of the Estate Duty Act. What value? Proceeds. What section tells you what the value would be, 51A. This is very helpful. So what I'm trying to tell you, if you do estate duty, it's not just a little quick calculation, like many people do. Total property as per the L&D. Minus quickly the liabilities and the administration cost. We get that. Minus 4Q, minus 4A, thank you. No, guys, no, not that simple. Property awarded, 3.2. Now let's just go back one step to property sold. For estate duty purposes, the proceeds will be the value. That's not the value for your L&D. Please, guys, that's not your value for L&D. This person passed in 2012. His property was sold in 2022. You can never put that value into the L&D. It's not applicable at the date of his death. It's applicable for estate duty. You cannot put that into the L&D. You put the value at the date of death into that L&D. Because, like I've said, if this person bequeathed his entire estate in a certain formula or percentages to certain people or certain heirs, then this is going to be wrong. Anyway, property awarded, sworn appraisal. Now listen, if there are no estate duty, if there are no capital gains tax, you don't have to have the sworn appraisals. You can have just valuations. You can just have municipal valuation. That would be fine because there are no duties involved. But the moment estate duty kicks in, this is what you need. Property awarded, REV 246 form. You have to get that. Farmland, again, sworn appraisal. And then the section 1.1 definition gives you the 30% off. What value goes into your L&D? Not the net value after the 30% off, the gross value. Unless you want to give away a couple of rands, 3.5% remuneration, give that away to whoever. You don't want that. You also want to deduct that from your fee. No, that's just the calculation for estate duty. And if you look at the estate duty form, did you see? You start at the L&D value. Okay, if it's a very tricky one, you have to, we'll look at that just now. You start at that, but you have to make adjustments at the value as per the L&D on that revenue form. Then it tells you on page 2, it gives you the place where you deduct the 30%. Why would the form be like that? It tells you in your L&D the gross value goes in, not the value after the 30%. Thank you, Jannie. You just earned me a couple of rands extra now for remuneration, executives remuneration. Okay. Same thing with unlisted shares. Now, unlisted shares is an interesting one. If your deceased owned a membership in a closed corporation or shares in a private company, and estate duty is applicable, he bequeathed that particular share to his son or a trust, and estate duty will be applicable. You have to value that. I'm saying SARS valuation. Your auditor has to value that, and SARS must approve that valuation. And that valuation is according to section 5.1F bis. If you never read that, then read it and get your accountant to do this thing correctly. Now, let's say this unlisted shares in that company, you have an underlying property. That property, immovable property, that has to be valued by a sworn appraisal, and you have to get the REV 246 form. You just have to get that. So what does this value entail? This value says, 5.1F bis says, you value all those assets in this company at its market value. You can get sworn appraisals for immovable property. You have to have sworn appraisals. You can have sworn appraisals for everything. Then you deduct all the liabilities. Then you get a net value. Now is the trick. That's where 5.1F bis comes in. 5.1F bis tells you now you have the net value, the net asset value. That's not the value for estate duty. That may be the value for the L&D. In fact, that is the L&D value, unless there is goodwill. You have to add the goodwill then. But anyway, then for 5.1F bis, it says, now you have to provide in this company. If this company had been liquidated today, what capital gains tax and other taxes this company was going to pay, or was going to pay, to deduct that from the net asset value. And then you have, after the taxes, you have a further net value. So that is the value that you can distribute to your shareholders or to the members. But if you distribute that value, there will be a dividend tax of 20%. Deduct the 20% dividend tax from that, and that's the value for estate duty. Let's move on. Usufructs, you know how usufructs work. 51B, I'm not going to discuss that. Life assurances, why is it subject to estate duty? 33A, 33D, right to dispose. Okay, let's look at 33A first, proceeds, 51A. Who pays? Oh, I forgot to talk to you about the who pays. In the case of a usufruct, the beneficiary pays. In the case of a life assurance that had been, where there is a beneficiary involved, that beneficiary pays. So in the end of your calculation, you have to calculate who's going to pay these taxes, and you have to apportion it according to the executive pays and what the beneficiary is going to pay, and to deduct that from the beneficiary's amount. So now your problem here, life assurance. The son got 5 million life insurance. It's not going, he was the beneficiary on that policy. So that money goes directly to you. But that's subject to estate duty. 20%, 100, in this case, 1 million rand, 20%, 1 million rand. He's got to pay that 1 million rand. You have to collect that from him. Hopefully, there's more than enough cash. So let's say he was going to inherit 2 million rand from the estate. You deduct that 1 million rand estate duty from his 2 million rand that he's going to inherit. If he's not going to inherit any cash out of the estate, problems. You need to talk to this guy very early in this process. So something else you need to do, even before your L&D is set up, you get that policy schedule from this broker and you deal with this broker. And you tell this broker, if anything is going to be paid out to whoever, I need to know immediately. Immediately. So you need to know you have to recover money from a beneficiary. I'm in a position now where we have to do that, and I'm afraid you're not going to get the money. The guy spent it all. All right, then the right to dispose, that's our section 3.3. No one deals with section 3.3. They think that doesn't exist. Let's look at this example. And then you need to know what you have to do. This guy was previously married. Oh, if he's previously married, you have to get that divorce settlement agreement and the divorce order from court. You have to get that. Because what did this guy do? At his divorce from his first wife, he was going to keep the primary residence. But that primary residence happened to be registered in a trust. In terms of this court order, he has now the option at his own cost and at his own time to transfer that property out of the trust into his own name. He never done that. Now he passed away. He always had the right to dispose of that property. 33D. That's a deemed asset that goes into his estate. So what happens now in practice? There will be two transfers. One out of the trust to him, his estate, and then from his estate to his beneficiary. So you're going to pay, are you going to pay a transfer duties? No, because in the first case, there won't be transfer duties in terms of the divorce order. That's an exception or an, what's the word again? Not exception, exclusion. And in the second case, it's out of the estate. It's also an exclusion for estate, for transfer duty purposes. But that's Jan's forte. That's where he comes in. He helps us with those stuff. Right. Okay. 4A. Very important. 4A. So my client had 3 wives, all predeceased. And now he lives with his secretary for the past 7 years. And then he passed. For 3 wives, 1 secretary. Now, what's happening here? All 3 predeceased wives passed. So if a deceased has or had a predeceased spouse, Section 4A1 says then you start at your rebate at 7 million. Then you go back to those 3 estates of those 3 previous predeceased wives. And in those estates, you now see how much of their 4A rebates did they use. So the last wife used all of it. She gave all the money to her children. So used her 3.45 million. So if you choose her as his spouse, then his calculation is going to be 7 million less the previous spouse used up 3.5, less 3.5, then he only has 3.5 million rebate. Okay, now you see, but hang on. His previous wife, his second wife, she only used up 1.5 million. She gave 1.5 million to her parents. So she liked him a bit more, it seems. So now you say, okay, now he's got 7 million. Less her 1.5 that she used up. Now you're looking at 5.5 million. Okay, now you're winning a little bit. And then you decide, hang on, guys, let's just go back to the first wife. Maybe she was more in love with him and she gave everything to him. And that is what happened. She passed away 10 years earlier and she gave everything to him. So she used nothing of her 3.5. At that time, it may have been 1.5, 2.5, doesn't matter. The Act says for 7 million. What did she use up? Nothing. So now his calculation is 7 million, less nothing, and he gets a rebate of 7 million. So now, sad in death, his executor now will choose the wife, which is most advantaged for him. A little bit late, but it's done. But now, he also has a spouse, his secretary. He never married her, but they're living together for 7 years, or they lived together for 7 years when he passed. Does she qualify for 4Q? He bequeathed almost all of his stuff to him. So yes, she qualifies for 4Q, but you have to prove that she was his spouse. Section 1 definition of the Income Tax Act tells you who a spouse is. SARS on their website tells you how to prove that it's a wife, a spouse. So living together as husband and wife, affidavits from people that know them. Oh, they had some assets together. Oh, he was paying a medical. Whoa, okay. They had some policies on each other's names, all of that. That's how you prove the 4Q if it's an unmarried spouse. How do you prove the previous, let's just go back one step. How do you prove Section 4A that the previous wife or spouse never used up any of that money? You have to get that L&D stamped by the master or the revenue form stamped by the master. That means you have to go back in archives 10 years back and get that L&D. I've once actually just redone the whole L&D and submitted it again. Luckily, I had the data because those files before certain dates are gone. And you can't leave this. That 3.5 million is worth 700,000 Rand. You can't just leave it out. You have to look at that. Thank you, Jan. I think we can now go to the last slide. Now, obtaining tax clearance, you can do nothing without that little, what SARS calls DEC. You have to get that. So to obtain the tax clearance, I normally do the following. I apply for that tax clearance on the next basis. Jan, if you turn the page now, I will submit to SARS an L&D pack because SARS may audit L&D. That's the L&D, full L&D with every single voucher. I'll just do that, send it in, whether they want it or not, because if they query it, it's there. Then the income tax pack, that last income tax calculation with all the capital gains tax stuff. So the income tax will be a calculation. It will be on spreadsheet, and I will give voucher numbers for every single little thing that's been taxed, and the voucher will be there. They'll be numbered. L&D pack, same thing. L&D, there's your L&D. It's numbered. There are your vouchers. Income tax, exactly the same principle. There's all the incomes. There are the expenses. They're all numbered on the side. The capital gains tax, same thing. You saw my example previously. There are all the capital gains tax calculations. There are all the base cost, proof of base cost, proof of proceeds. Estate duty pack, the same thing. There's the estate duty. So for estate duty, for argument's sake, the farming property, it's going to be the same document for the L&D and the income, same document, but there'll be the 30%. So most of these documents will be duplicated, but I put them in packs. And I put a heading up, actually put the covering little document, estate this, that, and the other, estate duty pack, scan it, make it the smallest possible PDF document, break it up into 3 portions if it's too big, and send it to SARS. And then we wait for them to reply. And then send their queries, all gets done. And normally when the audits take place, you get a name. There will be a Tina Yuhu or somebody. Now you have a person to deal with, and then you get things done. Jan, we can now move to one page. And that is thank you, guys. That's the end of the discussion. Time for questions.
Jannie, unbelievable. It was just amazing. Well done. And thank you. I found it exceptionally interesting. Thank you. I will now read the questions and then you can answer it. People, we did go over the time, but I think it was worth it through and through. So, right, let's see what questions we've got. Unfortunately, mine won't open. I don't know what's going on. Oh, here it is. Yeah. Let's start at the top. By the way, before I read the questions, I think the slides, we will send that with the recording. There's some very interesting and valuable information. So I'll definitely see to it that we send the recording as well as the slides, the PowerPoint to you. Good morning. Can we record the meeting? Well, yes, that will be recorded, as we've said. The meeting is being recorded. Thank you, Kanya. Good morning, all. We'll be sharing the recording. Jannie, yes, looks like a question. If the executor has mandated an attorney to do the estate legal work, will the attorney apply for registration as the estate tax practitioner?
Now, an attorney, okay. If an attorney deals with this deceased estate, that attorney does not have to be a tax practitioner. SARS will allow that attorney as the executor to deal with the estate taxes. But I find that many attorneys just pass it on to tax experts. But the attorney will not have to apply and register as a tax practitioner. I hope I've answered that question.
Thank you, Jannie. I think
that's mandate on attorney to do estate legal work.
Yeah, it says if the executor is mandated an attorney, or it's a power of attorney to do the estate legal work, will the attorney apply for registration as a tax practitioner?
No, you don't have to be a tax practitioner. If you're a registered attorney, you don't have to be a tax practitioner to do tax work. No.
Thank you. I think we've answered Kevin's question there. Elmarie, what if there is a first account and later on a second account? What is the effect of the income tax on the estate? Does income tax end with after the inspection of the first account or the second account?
The last account. You could have 3, 4, 5, 6 accounts. So take note that if you have a second account and you come across some other assets that will have to be added for estate duty, and the income that's been earned from that asset will have to be accounted for. So you account for everything. So what I did in one particular case, we had 4 accounts. We just lumped those 4 accounts together in one final account. We didn't publish it for tax purposes and for estate duty purposes. We lumped them together, combined them in one account with the final numbers, and all the incomes, expenses, we lumped them together into one, and then we calculated the final taxes and the final, because that's what it is. The fact that you have interim accounts is because at that time you don't have all the data. So you have to account for everything going forward from your first account. If you publish your first account in the first 6 months, I'm sure you don't have all the data at that point in time. All right, so yeah, so that's what we've done that now just a couple of weeks ago with one huge estate where the data came in drips and drabs, and then we just I actually took all those accounts and then I accounted for all of those assets in one account. That was not published, or that was not gone through to the master, because everything was accounted for in the previous accounts, but that was for our tax purposes. Thank you, Elmarie. Good question.
Thank you. Here's just a request, actually. Could we have a session regarding the implication on VAT pre and post death? Sometimes, as this can also complicate the taxes. Thank you for the suggestion, Kath. We'll keep that in mind, and I'll chat to Jannie, and maybe we can set something up for the future. Then there's a question: which section takes preference relating to primary residence awarded to spouse? Primary residence exclusion in brackets 8th schedule or section 9HA?
They interlinked. I'm not sure that one takes a preference. I'm not sure whether I missed something here technically, maybe, but there's not a preference there, because the 8th schedule says that. Now, in this particular case, excuse, I hear what you say. It's 9HA. If there's a death, it's 9HA. Okay, 9HA.
Why not? Okay. How would we be able? Sorry, there's no. How would we be able to claim the CBD? Will there be a question? Sorry, that's got nothing to do with you, Jannie. We will send you the certificate. Can we get a copy? Yes. Ursula, I think that Jannie is a good speaker, kept me focused. Jannie, what is your consultation rate per hour? Ursula, I think you need to speak to Jannie directly. If you didn't take his contact details down, then please contact me and I'll send it to you. Who can supply sworn appraisers? Jannie,
okay.
Can you answer?
Yeah, I'll answer that for you, Pamela. Good question. The Act says it's got to be the master, because it's got to be the sheriff. All sheriffs of court are supposed to be valuers, and they also subject to the promulgated rates. But I tend to move away because the sheriffs aren't that clued up anymore. So what I'm trying to do is there are many companies that do sworn appraisals. So you can Google around and get them. We use a couple of companies and they're very good, but every town or every area has got people. So what you can do is you can have a look at, there's a website called the South African Valuators. I can't remember there, but look for the valuations, the professional valuators sites, but I use those people and they're very good. But I also use the sheriff from time to time. But just bear in mind that the cost could be high. The sheriffs are subjected to the Act in terms of the rates that they may charge. Just bear that in mind.
Jannie, thank you. From Adrian, she says Jannie is very knowledgeable on the topic of discussion and it's been very well presented. Pamela, how can you close the estate if ED is due from a beneficiary who won't pay estate duty? Yeah.
You can't close the estate. Problems. I don't know how you're going to get around that one. I've got one problem like that now. I still don't know how I'm going to get around it.
I suppose you'll end up issuing summons against that person.
Yes. You'll have to take legal action, summons, and but you can't close it.
Roxanne Jacobs, can you choose the spouse to benefit from?
Yes, I'll explain that. You pick the spouse. And I made that stupid joke that in death, the executor now choose that spouse.
Jannie, we're running out of time, so I'm not going to read all the thank yous. It's obviously people were very impressed by you. Thank you, Jannie, brilliant. Jannie Rossouw was fantastic. Very informative. Thank you. Can you please repeat Jannie's email address? I'll show it to you now. Excellent presentation. Thank you. Thank you very much. Yes, Jannie. Fantastic webinar. Thank you, Jannie. Great presentation. Yeah, I don't think there are any other questions. Just want to go through. Anyway, Michelle Folscher says, any way found to expedite the issue of DEC for the estate as taxpayer? Average time to receive seems to be 4 months at present.
Nee, man, we waited 2 years for one. Okay, now look, there's a process that SARS has to follow. So normally when you get to the DEC, there's a person involved. You get a name, like I mentioned Tina Yuku's name, but it's not necessarily her. And you start putting pressure on that people. But then after you've sent them 4 or 5 emails, then you go to, at SARS on their website, you have a complaints little button. You go to the complaints, and then normally you get quick result. And if you don't get that complaint is not dealt with, you go to the ombudsman. We never went further than a complaint point, and then we got. So I think you don't know about the complaint maybe, but look at your complaint. Lots of complaints through the SARS website.
What email do you send the text document to obtain the DEC, Jannie?
I think it's called estates@sars.gov.za. The email is on their website. I think it's called estates at SARS. I can't remember. But yeah, just check on the website. Yeah.
It's probably on the website, yeah. Here's a long question from Karen. Karen, how do you deal with CGT of listed shares post-death, i.e. CGT is paid on the deemed disposal at date of death? After expiry of the L&D notice period, the share is then transferred to the heirs, in brackets, not surviving spouse. Where is the capital gains tax declared and paid?
Very good one. Okay, let's go through this quickly. Listed shares, first of all, that listed share has got a base cost and it's got a value at date of death. So that'll be the deemed capital gain. So now at date of death, that deemed disposal has got a proceed or the value. That proceed or that value becomes the base cost for after death. So if you transfer if your share is transferred to anyone else, nothing happens. If it's sold, I see you say state there. Notice the share is then transferred to there. There won't be an estate duty. There won't be a capital gains tax if it's transferred there. But let's just, so there's no declaration and no payment on if the share is transferred. The only capital gain takes place at date of death. It's only when you sell, when let's say the executor has sold that share, then there will be a second, and that will have to be within the expiry of the R&D when it's sold. Then there will be a second one. So let's say you transfer that share to the heir, and the heir sells it. The heir will be in his or her personal capacity declare that capital gains tax. But now I want to mention something which I forgot to say in the meeting. That base cost. You have to keep track of the base cost. So what you have to do is you have to keep that L&D with that base cost, because that L&D will show the base cost for the heir. So you have to keep that, because now the company, let's say the broker, PSG or whoever, or Standard Bank brokers, whoever they are, they would not know about the new base cost. When they sell that share, they're going to issue that beneficiary, that heir. They're going to show in their IT3C, they're going to put down proceeds 100,000, and then the base cost going back before. Now this person is going to pay double the tax. So this person has to have at his or her disposal that L&D to be able to prove to SARS, I have actually got a different base cost. Otherwise, there's going to be double taxation. That happens a lot. So Karen, I didn't mention that earlier, but that's a very good point. So if you sell it, there's no double taxation, but where that person sells it after L&D, and that person does not have access to the base cost through the L&D, there will be double taxation. Thank you. Good question.
Pamela asks, if the executor signs a power of attorney to an agent, who has to register as PO at SARS?
Executor.
Not the person they're giving the power of attorney to.
Executor. That's why this elderly little Tanny of 80 years standing with the ID smiling.
Stephen, what are the advantages and challenges of repudiation by other heirs in favor of the surviving spouse, including after estate has been wound up and closed?
No, there cannot be repudiation after the estate has been wound up and closed. Then that will be donations between parties. There can only be repudiation whilst the estate is open, because that's then part of the administration process. And if there are immovable property involved, then Jan is a conveyancer. You have to have those documents, because that's the causa of who gets whatever. So, with very good question, Stephen, in the sense that if there's a repudiation after date of death, those are donations. Donations between parties, that'll attract donations tax of 20%.
Thank you, Jannie. A question from Mariki. If you are appointed on the power of attorney to attend to the estate administration, will SARS link the deceased profile to the agent? We recently picked up that SARS also linked the executor's personal tax profile to the agent.
Mariki, I won't be able to answer this question. If you put that to me in writing on my email, I'll get my staff member, my specialist, Mimi, to answer that. Unfortunately, we just get the profiles. I don't know exactly how she does it, but I work from the profiles, but she's the expert there. So drop me a line on that one, and we'll ask Mimi to assist you.
A question, what is SARS turnaround time for deceased compliance letters to be issued? Somebody says at least 4 months.
Yeah, 4 months, could be longer.
Okay.
Yeah.
Marcel, note to ask for the DEC for the estate as taxpayer, i.e. post-death, else SARS issues it to pre-death, which is no good. Okay, that's not a question. Everybody's saying thank you. Yes, we're going to send the recording and the notes. Yep, Jannie, I think, what email do you send the text?
Jenny, contact us is not for the deceased estate. Don't send it.
Say again, Jannie.
Jenny, contact us at SARS. That's not for the deceased estate.
So there you are. Contact us. Oh, thank you.
Yeah, but don't use that address, Jenny. There's a different address. It's called, I think it's estates at SARS. Just check it up on the website. Don't use that one for deceased estate. You can use that one, but if you do it estates, it's better. That's what I use. Okay, carry on. Sorry.
Please discuss redistribution agreements and the donation tax implication if the heirs take benefits not equal to the will or interest benefits. Jannie, I think that's a discussion and a webinar on its own.
Yeah.
Okay.
Generally speaking, just a quick answer. Generally speaking, in redistribution, there has never been a donations tax issue. The Act doesn't specifically describe that, and I've actually researched that, but we can discuss that in a different discussion. Estate duty at SARS. There it is. Thank you. Thank you, Inga. Mariki, or what's the other lady's name? There it is. That one at the bottom. Estate duty at SARS.
Okay, great.
Those are the right ones.
Thank you, Inga. Wonderful. How do you escalate estate duty assessment?
At estate duty at SARS. Thank you, Inga. You just answered that question. Estate duty at SARS, or to that person that deals with it, if you have that person's direct email address.
Wonderful. Jannie, I just want to go to your contact details. There you are. People, yeah, there's Jannie's contact details and email address. Welcome to contact him. Jannie, once again, thank you. I think it was exceptionally successful and very, very informative. You're clearly a natural. You know, I will chat again, and maybe we can do something similar again in the near future. Thank you, Jannie.
Thank you, everyone. Thanks.
Thank you.